Welcome to Private Equity Profits. Clifford Locks is a certified board of director, a trusted confidant to CEOs, C-level exec, and high-potential employees to help them clarify goals, unlock their potential, and create actionable strategic plans. Seth Green is the nation's foremost authority on growing your portfolio companies with direct response marketing. He is the founder of the direct response marketing firm Market Domination LLC, and he is an 8-time best-selling author who has been interviewed on NBC, CBS, Forbes Inc., CBS Money Watch, and many more. Cliff and Seth interview top players in the financial sector, focusing on private equity firms, venture capital companies, and family offices, discussing developments and trends shaping the industry. These experts will share with you how they've grown their businesses and increased profit, and how you can too. And now, here's your host, Seth Green.
Welcome to the podcast. This is your co-host, Seth Green. Today, I've got the good fortune to be joined by Jeff Gold, President and CEO of Goldmark Advisers, a boutique investment banking firm. Jeff, thanks so much for joining us.
Glad to be here.
Let's go back in time a little bit. You've got an incredible history. How did you get started?
Wow. Well, let's see now. If you really want to go back, after I got out of college, I started work at a public accounting firm, not because I wanted to be an accountant, but I thought it would be a good place to get exposed to industry and corporations and, kind of learn how business works. And that worked out very well. I was there for 4 years. Then I joined a company, National Patent Development Corporation, and they were the originators of the soft contact lens. It's a very interesting company run by a couple of patent lawyers. And before very long, we were 4 different public companies, and I was their chief financial officer. From there, I segued into another position at Esquire Inc., which was then a $200 million New York Stock Exchange company. I was their chief financial officer, and my activities there were primarily finance administration and corporate development. So I was the guy who worked with them on acquisitions and divestitures, and we did both. At the time, Gulf and Western, you may be too young to remember Gulf and Western, but one of the original conglomerates, they had a 25% ownership position. Company Gulf and Western was run by Charlie Bluthorn. They also owned Paramount Films in Madison Square Gardens and a bunch of other things. So Charlie died. Marty Davis became chairman. Barry Diller was running the entertainment group, and Dick Snyder was running Simon Schuster. And they decided that they would buy the balance of the 75% of Esquire that they didn't own. They did that. I actually didn't want to work at a $1 billion subsidiary of a $4 billion company. So I left and started Goldmark. So, a long way of getting to Goldmark. Started in the mid-'80s as a boutique firm, primarily doing M&A, primarily doing buy-side M&A. Most bankers would rather be on the other side of a transaction. That evolved to doing M&A both for buyers and sellers. And then that evolved into doing corporate finance work. When you do corporate finance work, effectively the sale of securities, it's regulated by FINRA and the SEC. So I had to get licensed. I decided that I didn't want Goldmark to become a broker-dealer. It was too complicated. There was too much compliance-related activities. I'd spend my life doing administrative work rather than deal work. And so I did this, the next best thing, which was to affiliate with an existing broker-dealer and register my license with them and have all the securities-related work go through that firm. It happens that firm is a company called Young America Capital, and between Goldmark and Young America Capital, we're about 60 professionals, spread around the country, but mostly on the East Coast or east of the Mississippi. And we still do M&A and corporate finance. The firm itself, I never like to get pinned down, but we're a generalist firm, but half of what we do is media and entertainment. And between the two firms, we have strong healthcare, we have strong consumer products, media and entertainment. We cover most of the verticals. And
that makes a lot of sense. I'm sure the longer version of that story is in a book somewhere where it should be.
Not really.
Not yet. All right. And
No.
then who is an ideal client for Goldmark? I mean, you mentioned a bunch of different verticals.
Right. Well, unfortunately, the best clients go to larger firms, more established firms with recognizable names like Goldman Sachs and smaller boutiques of firms that have been spun off by some of the majors. I'd say we're middle market focused. Everybody defines middle market a little bit differently, but say companies that are $20 to $200 million in revenues. So we're focused on the middle market. We deal with primarily private companies, not public companies. And from my point of view, an ideal client is an established, profitable company that decides that they want to supplement their organic growth with some outside acquisitions. We get hired to help them make a series of acquisitions, and then we keep on building the business, and eventually they come back to us and they want an exit of one sort or another. So then we sell them or we help them go public. That's kind of an ideal client. If I had a choice of doing M&A or corporate finance, I would rather do M&A.
What do you think some of the biggest mistakes those middle market firms are making when it comes to thinking about their acquisition and exit strategies?
Well, they pay lip service to it. In other words, they talk about growing the business and they talk about making acquisitions, but for the most part, that means that they answer the phone when the phone rings. And basically, if you're a CFO or if you're your chief business development officer of one of these middle market companies, you have another job. You're doing something full time. And so when that phone rings and gets your attention, you're not doing anything preemptively because whoever called you called a dozen other people like you. And so you get into a competition. So I think the biggest mistake is companies don't become really proactive. And if they're proactive about it by designating or hiring someone, corporate development, strategic planning, to take over that responsibility, it doesn't get done. Or if it does get done, they pay more for it because they won the bid. And that could be good or it could be bad.
You've been in the industry a long time. How are those clients, how are those middle market companies finding you?
That's we haven't done any advertising. We are on a couple of lists. Every once in a while, I get surprised that we show up as the on a list of the 50 best boutique investment banking firms. We are also in a variety of different lists. So once or twice a week, I get an email from someone who is obviously sending that email to many others. I've actually gotten clients that way. But most of our clients are word of mouth. We have stepped up and have done some business development. So for example, we may, using something like Zoom Info, identify the CEOs of the, let's say, media and entertainment companies based in LA with revenues of 20 to 50 million. So we target them and then send a mailing. But for the most part, it's word of mouth.
Okay. And then what do you like best about what you do?
Well, I'm a deal junkie. So, I like the action. But I'm a different kind of deal junkie because I didn't grow up on Wall Street. I wasn't originally a banker. I was originally first an accountant and then, a business development, strategic planning, finance guy. Um, so, I kind of have a lot of experience and have a sense of what works and what doesn't. And a lot of companies, Wall Street bankers, they're all bid and ask, they don't know much about the company. I'm reminded of a story when a very well-established Wall Street banker who sat on the board of one of the companies I mentioned earlier, tried to do a deal for us, and we had no idea what the company did and what our strengths and weaknesses were. So, how do you negotiate with with someone like that? So, I'm more of a corporate M&A, corporate finance person versus a Wall Street kind of person. I don't know if that, that could be good or bad, but
Sure. I think it's just different depending on the deal, right?
exactly. And I like um, I like to analyze a company, determine its strengths and weaknesses, get a sense of what its personal chemistry is and how it likes to operate. Can you imagine buying a very entrepreneurial company that, hardly generates financial statements, and then the day after the acquisition require them to prepare monthly financial statements and get it to you by the 10th day of the following month? It's just crazy. So
How have you seen the landscape change since the COVID pandemic?
we had a very strong year in 2000, so I wouldn't have expected that when the pandemic started. But it's been pretty strong and getting stronger. There's a lot of money out there chasing deals. And in the old days, you only had one kind of buyer. It was a strategic. Well, now you have all these private equity firms, and now you have venture capital firms that are getting into private equity. And you have hedge funds, and you have family offices. So there are a lot more people chasing deals, and there's a lot more money out there. So it's become more of a process. And now you can do deals, over Zoom. I've raised money from people I haven't met for clients I haven't met. It's quite encouraging to be able to do things much more efficiently. I used to have an office in the city, and now I have an office at home, and it's working out incredibly. I have Zoom calls with people all over the world, and how could you do that? Um, if you're trying to bring everybody into New York into a conference room.
Absolutely. Talk a little bit about your due diligence process.
Well, it depends upon who we're representing. So, if we're representing a seller and we're putting an information memorandum together, that's information that we're generally getting from the company, and we're editing it, and we're auditing it, and we're making sure that it's realistic. So there's the due diligence that goes into that. There's also FINRA related due diligence. We have to get copies of driver's license or passports, and we have to do background checks on clients. So we're doing pretty extensive due diligence. We generally like to get paid for doing that, which means that when we're retained by a client, the first 30 days of our engagement is usually putting together, doing the due diligence, putting together an information memorandum, and putting together a target list of buyer prospects. On the buy side, the due diligence that we're doing starts off with getting comfortable that the company has articulated what they want to do, and then finding those opportunities for them, and then doing due diligence on those acquisition prospects. But the due diligence on the acquisition prospects should be done primarily by either the company, outside counsel, or outside an accounting firm, because we are not absolutely independent, in the sense that typically our fees are a percentage of the purchase price or the sales price. And if a transaction doesn't close, we don't get paid. So we always say to our clients, the bulk of the due diligence is your responsibility. We'll help, we'll help analyze, and we'll certainly ask for information, but ultimately you have to make the decision based on the due diligence that you or your representatives do. But it's pretty extensive.
Absolutely. Well, we know your time's incredibly valuable. We appreciate you spending some with us. What else do you want to share that I didn't think to ask you yet?
Yeah, I mean, where is the market going? I'd say it's going to be strong for the balance of the year. I'd say, usually summers slow down. Maybe this year it's going to slow down even a little bit more, because last year no one went away and everybody's now planning a vacation, including myself. One of the new phenomenons that you didn't ask about, but I'll kind of volunteer, is the new game in town, which is the SPACs, and how that's affecting the business. There are a lot of SPACs out there. It's slowed down a little bit, but there are hundreds and hundreds of SPACs that have raised anywhere from a low of 50 to $800 million, and probably the average SPAC is raising, $300 or $400 million. And there are a lot of those out there. And when you start to get close to your 2-year limit, people are doing strange things, so they don't have to give the money back. So that's become a new competitor. Not a competitor for investment banking business, but on a sell side, I have to think about, okay, there are strategics, there are private equity firms, and now there are SPACs. So that's a phenomenon that taking into consideration now. But it's fun. It's a great business to be in.
Absolutely. Well, we greatly appreciate your time. This has been Seth Green with Jeff Gold of GoldmarkAdvisers.com. Jeff, thanks so much for joining us.
You're welcome.
Thanks everybody for watching or listening. We'll see you next time.